How to improve crypto analysis for beginners. Hello everyone. Welcome back to Mr. Suw Crypto, a place where we learn together about the world of crypto without complications, without pretentious jargon, and of course, without promises of instant profits. Well, this time we're discussing a topic that, let's be honest, is often asked by beginners. The question is simple, but profound. Bro, how can I get better at crypto analysis? It's a good question, because honestly, in the crypto world, too many people slip up not because the market is bad, but because their analysis is shallow. Think about it. How many of us first entered the market because a friend said, "Hey, this coin is going to skyrocket, bro," or saw an influencer dancing around saying, "Buy now, it'll go up 10x, dude." And boom, money gone, emotions running high, blaming the market. But the real issue isn't the market, it's how we view the market. So, this episode isn't just for beginners, but for anyone who wants to level up from just following the crowd to becoming someone who understands why they buy, why they hold, and why they sell. I'll discuss 4 key foundations that I believe are crucial for improving crypto analysis, especially for those just starting out. And we'll discuss them slowly, calmly, without complicated jargon, but still sharp and substantive. What we'll talk about isn't price predictions, but rather the mindset and approach to analysis. Because trust me, having the right mindset is far more important than just chasing quick profits. Crypto is a marathon, not a sprint. So, grab your coffee, or if you're listening while driving or working, focus your ears, because after this we'll dive into Chapter 1, why you must understand blockchain technology before daring to make money. If you're ready, I'll move on to Chapter 1. Chapter 1. Learn about blockchain technology. Alright, let's start with the most basic foundation, but one that is often overlooked, understanding blockchain technology itself. Honestly, I'm not surprised that many beginners jump straight to questions like, which coin is good? Is this profitable? Or when will it pump, bro? Because it's natural for everyone to want to get rich quickly. But what's often forgotten is, crypto is built on a technological foundation that's very different from traditional financial systems. And if you don't understand the underlying technology, you'll just become the next victim of FOMO, buying when it's hot, getting stuck when it's cold, then saying crypto is a scam. Here's the thing. Imagine you want to invest in a tech startup. Wouldn't you want to know what technology they're building? Or how much potential their system has to be used by millions of people? Well, it's the same. When you buy crypto assets, you're essentially betting on one thing: the future of the blockchain technology brought by that project. So what is blockchain? Blockchain is essentially a digital recording system that can't be manipulated at will. Data is recorded in blocks, and each block is connected like a chain. That's why it's called a blockchain. Every transaction that occurs is permanently stored, and the data is distributed across many computers, called nodes, around the world. So no central authority can suddenly delete data or cheat behind the scenes. This is why blockchain is called trustless, not because it can't be trusted, but because you don't need to trust anyone. The system is designed to be transparent and resistant to manipulation. Why is this important for analysis? Now let's talk about analysis. Think about it. How can you analyze a blockchain project if you don't even understand how it works? For example, there's a new coin that claims to have a layer 1 modular with hybrid proof-of-stake consensus ZK rollup feature. If you don't understand any of the terms above, you can only hope. I hope this coin is actually good. That's like buying a car just because it's cool looking, without understanding the engine. In the end, you buy the coin during FOMO, get stuck when it's quiet, and don't know what to do because you don't understand the underlying technology. By understanding blockchain, you can start to distinguish which projects actually bring new solutions, which are just rebranding, which ones are too technical but have no real demand, and which ones are just jumping on the hype bandwagon. Where should you start learning? Don't worry. You don't need a computer science degree to understand blockchain. Start with the basics. 1. What is blockchain? 2. What's the difference between public and private blockchains? 3. What are smart contracts? 4. How does the consensus system work? 5. Why are Bitcoin and Ethereum so technically important? All of this has been extensively covered on YouTube, articles, podcasts, and even X threads, Twitter. But you have to be consistent. 1 topic per day is enough. The key is to understand the concepts, not just memorize the terms. Bonus: Understanding blockchain equals being able to read market signals. This is what people don't realize. When you understand how blockchain works, you can spot trends before they become hype. Understand why certain narratives, like modular blockchain, risk-taking, or ZK tech, emerge. And you can sniff out fake projects from their marketing language. So it's not just about knowing this coin will go up, but understanding why the market is interested, what technology is behind it, and how long the hype might last. The bottom line is, don't be a crypto investor who can only analyze charts but doesn't understand what they're holding. If you can combine technical chart analysis with a fundamental understanding of blockchain, your analysis will be far sharper and more confident. That's it for the first chapter. Next, we'll delve deeper into the importance of recognizing various sectors in the crypto world and why that can make you sharper in choosing coins relevant to market trends. If that's okay, I'll move on to Chapter 2. Chapter 2. Learn about all sectors. Now we move on to a chapter that is often overlooked by beginners. Understanding the various sectors within the crypto ecosystem. And yes, if you've been thinking that crypto is just Bitcoin, Ethereum, and cute cat coins, we need to have a serious talk. Crypto is not one world, but one galaxy. Imagine the crypto world as the real industrial world. There's banking, logistics, energy, healthcare, entertainment, each with its own role and function. The same applies in crypto. But the difference is, every sector in crypto is built on blockchain technology and may have its own token, economic system, and even its own community ecosystem. So if you only know Bitcoin and jump into a random coin just because it has a cute logo or the word AI in its title, you're actually playing in a field where you don't even know the rules. Some important sectors you need to know. Let's break them down one by one, so you're not just a spectator in the crypto world. 1. Layer 1 and Layer 2. These are the foundation of all crypto applications. Layer 1 includes Ethereum, Solana, Avalanche. Layer 2 includes Arbitrum, Optimism, ZK Sync. They are like the operating system of the crypto world. All dApps are built on top of them. 2. DeFi, Decentralized Finance. This is a revolution in the financial system. No banks, no middlemen. It includes lending, borrowing, DX, decentralized exchange, yield farming, and more. Examples: Aave, Uniswap, Curve. 3. NFT and gaming. Don't underestimate this sector. Despite the memes and speculation, the underlying technology is strong. Many games and major IPs have already entered this space. Examples: Axie Infinity, Immutable X, or projects focused on digital ownership. 4. Data and Oracle. Blockchain cannot retrieve data from outside the system without assistance. This is where oracles like Chainlink come into play. This is a crucial sector, but often goes unnoticed. 5. Infrastructure and tooling. Projects like Alchemy, The Graph, Celestia build the infrastructure developers use to scale blockchain and make it faster. 6. Real-world assets, RWA. This is a new sector with a huge future. Essentially, it brings real-world assets, like property, bonds, or commodities, to blockchain. 7. Res-taking and modular chains. This is part of the latest infrastructure trend. This is where projects like EigenLayer, AltLayer, and others emerge with new approaches to security and scalability. Why is this important for analysis? Because each sector has its own narrative and momentum. For example, during the DeFi hype in 2020 to 2021, all DeFi coins skyrocketed. But when the narrative shifted to Layer 1 and Layer 2, those that were once shining could suddenly fade. Another example: when the AI plus crypto narrative emerged, many AI tokens soared. Yet some of them didn't have clear products. They were purely driven by the narrative. If you understand the sector, you can ride the narrative wave when it's on the rise, but still know which projects have strong fundamentals. And not just buy coins because they're trending on TikTok. In other words, you're not just following trends, but understanding the trends themselves. How to start learning. Chatty suggestion: create your own sector map. Create categories like Layer 1, Layer 2, DeFi, Oracle, Gaming, RWA, Modular, and Res-taking. Then, each week, explore one sector. Read the white paper, follow the top projects in that sector, look for the latest news, and watch interviews with the development team. After a few months, you'll develop a feel and instinct. Wow, this sector is getting a lot of attention, or it seems like a new narrative is emerging from here. And most importantly, you'll feel more confident when choosing coins, because you're not just choosing because a friend said it's good, but because you understand the coin's position within the broader crypto ecosystem. Fatal mistakes to avoid. Many beginners buy coins just because. Cool name. Low price. Even though the supply is in the hundreds of billions. Influencer says hold until next month. But if you know the coin sector is actually irrelevant to current market trends, or even lacks active users, you'll end up stuck. So the conclusion is, understanding the sector equals understanding the context. Without context, all coins seem attractive. But with context, you can distinguish between noise and signals. Alright, that's the end of Chapter 2. In the next chapter, we'll dive into a topic that's starting to get a bit detective-like. How to identify the people behind a project, the backers, the founders, the puppet masters. Because in this anonymous crypto world, sometimes who's behind the project is more important than what they're building. If you're ready, let's move on to Chapter 3. Chapter 3. Try to learn about the backer. Okay, now we're talking about something that seems trivial, but can actually be a matter of life and death for your crypto portfolio. Who is behind this project? Yes, we're talking about the founder, the core team, the early investors, and everyone else involved behind the scenes. Crypto is an anonymous world, but that doesn't mean you have to be blind. One of the most unique and unsettling things about crypto is that many projects are run by people whose identities aren't entirely clear. Sometimes they use pseudonyms. Sometimes they only appear via tweets. Sometimes, well, just an anime photo. But here's the thing. If you're going to invest in a project, you should at least have an idea of who's behind it. Have they successfully launched projects before? Do they have a reputation in the tech world? Or are they former scammers with a shady past? How to start detective mode without becoming the CIA. Don't worry, you don't need to be a hacker to find out who the backers behind a crypto project are. Just be diligent and know where to look. 1. LinkedIn. If the developers are open about their identities, they usually have complete profiles on LinkedIn. Check their educational background, previous jobs, and whether they've worked on other blockchain projects. 2. Angel.co and Crunchbase. These platforms are commonly used by startups to list projects and funding. You can check if they've participated in incubation programs or received funding from major VCs. 3. Interviews and podcasts. Many founders have been invited to crypto podcasts or events. Listen to how they speak and think. Do they truly understand the industry, or are they just good at marketing? 4. Official website and white paper. The team is usually listed in the About Us section or as contributors in the white paper. Check for transparency regarding who is on the team. 5. Twitter/X and GitHub. Many developers are active on these platforms. On GitHub, you can see if they are actually coding or just copying and pasting others' projects. On X, you can see their track record in discussions, responding to criticism, and posting project updates. Early investors equals signal. In addition to the team, you should also look at who the early investors in the project are. Why? Because big players, VCs like A16Z, Sequoia, Paradigm, Binance Labs, and others, typically only invest in projects with real potential. If you see a new coin backed by a major VC, that can be a positive signal. But don't rush into it. Even big investors can make mistakes. However, their presence at least indicates that the project has undergone a fairly rigorous due diligence process. Real-world examples worth following. Ethereum, founded by Vitalik Buterin, Gavin Wood, and a transparent team from the start. They're not just skilled developers, but also have a proven long-term vision. Solana, Anatoly Yakovenko, a former Qualcomm engineer, understands distributed systems inside out. His team is open and active at various conferences. Polygon, built by an Indian team with prior experience in Layer 2 projects. They remain transparent about their roadmap and global collaborations. And examples to avoid. Projects with fully anonymous teams, no white paper, and no clear roadmap. Plus, their website is just one page with meme photos and the phrase, "We go to the moon." Come on, please. Founders who have pulled a rug pull but changed their name and started a new project. This happens quite often. Sometimes they use a new account. Sometimes they change their persona. But the Reddit and Twitter communities often uncover their dark history. The bottom line. Don't just look at the coin, but look at who created it and who supports it. Don't buy a coin because a friend said it's good, but research who is responsible. And don't be afraid to be skeptical. Crypto is full of noise, and the best skill is your ability to filter out who is trustworthy. Let's move on to Chapter 4, where we'll discuss fundamentals. Why they're still important even if you're just looking to swing trade or make quick profits. Because when the market starts bleeding, only coins with strong fundamentals can survive. Chapter 4, Fundamentals Matter. Okay, here's the chapter that beginners often skip, but is actually the main foundation of sound crypto analysis. Fundamental analysis. Yes, we all understand. Charts are cool, red and green candles are exciting, and profits from swing trading are tempting. But without understanding the inner workings of a project, you're basically just guessing with your eyes closed. Too many coins equals too many wrong choices. Currently, there are thousands of coins in the market. Every day, there are new projects, new tokens, and new hypes. But the majority of them? They're just passing through. They're popular for a few months, then suddenly disappear. The website is gone, the community disbands, and the developers are nowhere to be found. This is where fundamental analysis comes in, to help you filter out which projects are worth holding long-term and which are just riding the FOMO wave. What should you check in fundamental analysis? Don't worry, chatty, you don't need to be an economist to understand this. Just have a curious mindset and sound logic. Let's break it down one by one. 1. Use case. What's the purpose of this project? The first question that must be answered. What does this project actually do? Do they help with network scalability? Do they make payment systems cheaper? Or maybe they don't have a product at all. A solid project usually has a clear solution to a real problem, not just marketing jargon like revolutionary or Web3 for everything. 2. Tokenomics. Who gets what, when, and how much? This is the part most people skip, but it's like the financial structure of a country. Check. Total supply and circulating supply. Token distribution. What percentage goes to the team, investors, and community? Vesting schedule. When the team's tokens can be sold. If 50% of the tokens are held by the team and will unlock in 3 months, brace yourself for a dump. 3. Roadmap. What are they planning to do this year? Serious projects usually have a clear roadmap. When do they plan to launch the test net? When the main net? When to collaborate with major partners? And importantly, are they consistent with the schedule? If the roadmap just says Q1, grow community, Q2, moon, Q3, Lumbo, please just run away. 4. Partners and backers. Who trusts them? We've already discussed this in the previous chapter, but it's worth emphasizing again. Big investors equals additional validation. If the project has received funding from a well-known VC or is collaborating with a major entity like Chainlink, Coinbase, or a top university, it shows that they've gone through a rigorous screening process. 5. Community and ecosystem. Crypto isn't just about technology, but also about adoption. Check if their community is active, if there are developers building dApps in their ecosystem, and if the project frequently appears at major events. Projects with a strong community are typically more resilient during market downturns, as there is long-term confidence. Okay, but how do beginners start fundamental analysis? Here's the recipe. Start with the coins you own. Don't try to analyze everything at once. Start with the coins you've already bought or the ones you see most often on Twitter. Check the official website and white paper. Take 30 minutes to read the white paper. Highlight key points and terms you don't understand. Join Telegram or Discord communities. Read discussions. See how the team responds to technical questions and community feedback. Check CoinGecko or token unlocks. Review token distribution and vesting schedules. Sometimes hidden gems can be found here. Compare with other projects in the same sector. For example, if you're interested in Layer 2, compare Arbitrum versus Optimism versus Base. See which one is developing the most actively. Fundamentals equals a fortress during market chaos. When the market crashes, all coins will turn red. But only coins with strong fundamentals can bounce back and continue to grow. If you analyze correctly, you're not just buying coins, but investing in innovation. And if you consistently study fundamentals, over time you'll become better at distinguishing between projects worth investing in and those that are just fleeting trends. Let's move on to the final section. We'll wrap up this episode with a brief summary and, of course, the latest version of Mr. Suw Crypto's 5 rules. Time to level up. All right, we've reached the end of today's episode. We've been discussing how to improve crypto analysis, especially for beginners. And one thing is certain, there are no shortcuts. But there are many ways to make the learning process less stressful and more efficient. Start by understanding blockchain technology, then explore the various sectors, research the key players behind the projects, and most importantly, master fundamental analysis. If you've reached this stage, it means you're already one step ahead of most other beginners who are just following the FOMO trend. You're not just a market follower, you're starting to become a market reader. Remember, everyone can buy coins, but not everyone understands why they're buying them. And that's what separates speculators from investors. So keep honing your skills. Take it slow, but be consistent. Because in the crypto world, it's not the fastest who survive, but the most prepared. 5 Core Rules Updated Version by Mr. Suw Crypto. And before this episode ends, here's the latest version of Mr. Suw Crypto's 5 core principles. Don't just memorize them. Make them part of your routine. 1. Don't use hot money. If you're stressed every time you open the market, something's wrong with how you're starting. 2. Don't over-leverage. Wanting to get rich quick might end up with a margin call. 3. A healthy portfolio is 70% Bitcoin and 30% altcoin, not the other way around, especially not 100% meme coins. 4. Always have cash ready to buy the dip, because in crypto, storms always come without warning. 5. Think long-term. The market may be volatile, but your mindset must remain stable. Thank you for listening until the end. If you found this episode helpful, support Mr. Suw Crypto by liking, subscribing, leaving your thoughts or questions in the comments section, sharing with friends who are learning about crypto. See you in the next episode. Stay DYLR, stay realistic, and keep making profits together. Greetings from Chatty and Mr. Suw Crypto.